Well, hello. My name is Anthony Sakaro, founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer. And my goal in this video is to talk about a safe investment, or at least an investment that a lot of people think is safe, that may or may not be safe depending on how you hold it. And the investment that I'm talking about specifically are bonds. And we're in a very weird environment in today's world. The three main asset classes are stocks, bonds, and cash. And for the first time in 30 years, none of them look good. Well, the stock market doesn't look good for the reasons that I've talked about on other videos. And if you've watched any of my national news appearances at all, or if you've seen any of the other videos that I've done, you know that I think we have some problems ahead for the stock market. Stock market doesn't look good. The bond market doesn't look good either. Why? Because interest rates are probably going to go up. And that's questionable. It depends on what happens with the market, but interest rates are at historic lows, and the bottom line is they can't go down further, or at least theoretically they can't go down further. Now, will there be a negative interest rate policy put into place so they could go down further? Well, maybe. That is yet to be seen. But theoretically, interest rates can't go down further. So interest rates for a while could stay flat, or they could go up, but they really can't go down, and if they do go down, they can't go down much more for sure. So bonds don't look good because bonds act opposite of interest rates. I'll come back to that. And then cash doesn't look good because you're not earning any interest on any money that you have in the bank. So stocks, bonds, and cash, the three major asset classes, don't look good for the first time in 30 years. And a lot of people are familiar with these asset classes, and that's it. They're not familiar with anything else. And one of the biggest reasons for that is because these are all that's available inside your retirement accounts. Your 401ks, your 403bs, this is what's available there. So the reality is there's a whole universe of other investment options that are not available inside your retirement account, and so consequently, a lot of people don't even know that they exist, but they do. And if you want to know what those alternate investments are, well then you can see the video on our website or on our YouTube channel. If you were to go to providencefinancialradio.com, that'll take you right to our past radio shows, and you can link to our YouTube from there, watch the videos from there about these alternative investments. But when people want to be safe, when people that have retirement plans want to be safe, they want their money a little more secure than in the stock market, well, what do they tend to buy in lieu of stocks? Well, the answer is they tend to buy bonds. And the reality is that can be dangerous. It depends on how you buy the bonds. And that's what we're going to spend the rest of this video talking about. People invest in bonds, think that they're doing it safely. In reality, they're investing in bond mutual funds, and those could be dangerous. So in order to talk about bonds, we have to talk about individual bonds, and we have to talk about bond mutual funds and what the difference is. So let's start by talking about an individual bond. When you invest in an individual bond, you get two very important guarantees. The first guarantee you get is a guaranteed interest rate. The second guarantee you get is that at some point in the future, called a maturity date, you're going to get all your money back. So first guarantee, guaranteed income, guaranteed interest rate. Second guarantee is that at some point in the future, you'll get all your money back. Now, that assumes that the entity that issued the bond doesn't go bankrupt. If it's a corporation and you buy a corporate bond, it goes bankrupt. If it's a government, then theoretically governments can go bankrupt, and so therefore you won't lose any money. Now, we know from municipalities that some municipalities do go bankrupt. So you have to be careful even with municipal bonds. But if you buy insured municipal bonds, let's back up. So if you buy insured municipal bonds, you can be reasonably certain that you don't have anything to worry about. But as long as the entity is viable and doesn't go bankrupt, then you've got those two guarantees in place. But between the time you buy the bond and the time the bond matures, the value of that bond is going to fluctuate. And there's a lot of reasons why bond values fluctuate, but one of the biggest reasons has to do with interest rates. Now, are you familiar with the fact that bond values fluctuate opposite of interest rates? Well, a lot of people aren't, but that's how they work. So that means that when interest rates go down, bond values go up. And when interest rates go up, bond values go down. And for 30 years, interest rates have been coming down. it's kind of been like a plane coming in for landing. They've been coming down gradually, and yet at times they've had to pull up a little bit and then they come down again. Well, right now interest rates are on the runway. They're as low as they can go. They're at historic lows, even though the Fed raised interest rates by 25 basis points recently. That's 0.25%. They're still at historic lows. So right now, they can either stay low for a long period of time, I think there's a good argument for that, or they can go up. Now, if they start to go up, then the value of your bonds are going to start to go down. But that's okay, because as long as you hold them to maturity, then you'll get your money back anyway. You'll get the value of your bond back anyway. So really, it's just a paper loss. Now, meanwhile, if your individual bond goes down in value and you hold it to maturity, your original income stays the same. Your original income is not affected by that. So let me give you a quick example. Let's say that you have $100,000 in 10-year bonds that are paying 4%. Okay, just hypothetically, whatever the bond is, it's paying 4%. That means you're getting $4,000 a year of interest, and you can live on that interest, you can spend that interest, you can reinvest that interest, however you want to do it. You're getting $4,000 a year of interest. Well, let's say that the $100,000 drops down to $80,000. So now you get your portfolio one day, your statement, you open it up, and it shows that your bonds are only worth $80,000. Well, guess what? That's only true if you need to sell your bonds today. However, if you hold your bonds to maturity, then you will get your $100,000 back. Meanwhile, that $4,000 of interest that you're spending, that you're living on, well, guess what? That stays unchanged. Just because the bonds drop from $100,000 down to $80,000, the $4,000 does not drop. The $4,000 stays the same. So what's more important? Is it more important that the value of your bonds stay the same? Or is it more important that the income you're spending every year and every month stays the same? And of course, the income is the most important thing. Those short-term fluctuations are just paper losses. But that's only true with individual bonds. When it comes to bond funds, there's a different story. Now, those of you that have bond funds, let me ask you, do bond funds guarantee an income or an interest rate like individual bonds do? The answer is no, they do not. The interest sort of fluctuates. And do bond funds ever mature? The answer is no, they do not. So the challenge with the bond fund is the fact that you lose the two most important guarantees that individual bonds offer you. Namely, your interest is going to fluctuate, number one. And number two, there's no maturity date. So when interest rates start to go up, then your individual bonds are going to drop, and that's just a paper loss because you can hold them to maturity. But when interest rates start to go up and your bond mutual funds start to drop in value, well, guess what? You can't hold them to maturity because there is none, which means that that could be a permanent loss. And that's the danger with bond funds that a lot of people don't realize that they're getting into because their advisors put them into that situation. Now, if you have a 401k and you're managing your own funds, and of course you make your own choices and so on, and you have to choose the bond funds that are there. And what a lot of people will tend to do is they'll look at, how have these bond funds done over the last 1 year, 3 years, 5 years, and 10 years, and they'll choose the one with the highest interest. Well, the challenge is that doesn't work today. Because for the last 10 years, we said rates have been coming down. So your bonds have been going up in value. When you add some interest onto that, it makes your bond funds look like they've done a lot better than they really have. There's been a tailwind for bonds that has been going on for the last 30 years. But that tailwind is soon going to turn into a headwind. And the bond values are going to stop dropping. So what I'd recommend, if you want to be safe inside your 401k, is leave your money temporarily in the fixed account, at least while the market's trying to figure itself out. I don't mind if you get a couple percent at this point as opposed to losing a lot of money in the stock market. Or if you want to go with bonds, then go with short-term bonds. The shorter the term that the bonds that are inside the mutual funds are, the less volatility there will be, the less downward fall they will have as interest rates start to go up. If you pick a bond fund that has bonds in there that are 20 and 30 years, then when interest rates start to go up, those bond funds are going to go down a lot more than if you pick a bond fund that has bonds that are only maybe 4 or 5 years or 6 years or so in there. So short-term bond funds. Now the question that's logical, if you have an advisor, is why would my advisor not tell me this? Well, there's a couple of reasons. One is because bond funds are much simpler than individual bonds to buy. For example, when we go to buy individual bonds for our clients, I've had times that we will be on the phone trying to buy the bonds and they disappear immediately and we can't get them. Why? Because individual bonds aren't like stock. They don't come for sale immediately. When you buy a bond, you buy it with the intention of holding it. If you need the money, then you have to put that bond out there for sale through your broker. Now, there's 300,000 advisors in the country. And let me ask you, if you have a good bond and you put it out there for sale and you've got 300,000 advisors that have access to that bond, how long do you think that bond's going to stick around? It doesn't stick around a long time. So we've had them sold right out from under us. And the bonds that are available today, well, they probably weren't available last week and they probably won't be available next week. So every time we go to buy bonds for our clients, we've got to do the research again. So when you have a bond mutual fund, all that goes away. Your advisor can have one bond mutual fund or as many as he wants, but they're always available. The funds are always available. You can always reinvest. And by the time the office door closes after your meeting with him, he could have you invested. Doesn't work like that with individual bonds. So a lot of advisors take the path of least resistance and the simple path and invest in bond mutual funds instead of individual bonds. And of course, the cost to you is you lose the two most important guarantees. But there's another reason, and I hate to say this, I hate to bring this as a reason. I would think most advisors, I would hope most advisors don't consider this, but unfortunately, knowing human nature, I think they do consider it. And that is that individual bonds don't pay commission to the advisors. Bond mutual funds do. Individual bonds don't charge you a fee. Bond mutual funds do. And a part of that fee, well, guess where it goes? Part of that annual fee that the mutual fund charges you goes to your advisor in whatever proportion he gets based on the company that he works for. So unfortunately, I think that probably sways a lot of advisors to recommend bond mutual funds instead of individual bonds. And by the way, they're much simpler for your advisor to deal with as well too. So the nice thing is, as fee-only financial advisors, as a fee-only financial planner, we recommend individual bonds for our clients. Why? Because we still get paid to recommend them. But because there's no fee to you, and because we're not investing you in bond funds, to you, it's really just about the same thing. It doesn't cost you any more to get the advice that we would really want to give you. And our advice is not motivated by commissions because we are fee-only advisors. So hopefully that makes sense. As always, if you have any questions, please don't hesitate to call my office. My number here is 818-887-6443. Or you can stay in touch with us even if you don't have questions. Go like us on Facebook, but the way you're going to do that is providencefinancialradio.com. Go to that website, like us on Facebook. Every week I'm doing market updates, and if you're on Facebook, you'll see those market updates. So thank you. Hope this video has helped. God bless.